fact that we've moved, as you were saying, toward cash being the safe thing rather than bonds, which is kind of a qualitative shift from what it was usually the case. Because I like your framework of layered money. Um, because it's very useful of thinking about this. Under a gold standard, the base layer is gold. Under a Bitcoin standard, the base layer would be Bitcoin. In a fiat standard, the base layer is cash as well as bonds. And generally, I think perhaps one way of thinking about it, I'm curious about what you think of this. One way of thinking of it is that when things get bad, but moderately bad in a fiat system, then the safety is in bonds, and so you go slide down the risks spectrum from speculating on highly risky assets which offer high returns. You slide down to lower risk assets, and that means bonds. But if things get really, really bad, then people will not even trust bonds. And I think you could say, think about an example of a country experiencing very fast inflation. In that situation, bonds are not a safe haven. People will jump out of bonds to physical cash, or initially, I think it would be from bonds to cash, and then when cash can't handle it, then they'll go from cash to foreign currencies. Would you say that this was something like this, that it was indicating a bigger kind of lack of trust in the system, that people weren't even trusting bonds and were moving to physical cash?
Yes. So I think that we have to break down the word cash and the word bonds here so that we can correctly and fully answer this question. So remember that in the layered money framework, the counterparty at the base layer of the system is the US Treasury. Now, cash today, like if the average person were to think about cash, a cash balance within their portfolio, let's say this person had a retirement portfolio that's invested in stocks and it has some alternative investments, but then it has the person has a savings account. And he or she is looking at that savings account as that's my cash balance. But let's say that balance is $100,000. That balance is a liability of the bank. Let's say it's Wells Fargo. It's a $100,000 liability of Wells Fargo, but because it's only $100,000, it's FDIC insured, which means that the federal government has an insurance mechanism on that deposit. So that individual is thinking of that Wells Fargo 100K deposit as cash. And he or she is right to do so because of the insurance mechanisms. And that's actually part of layered money in the early 30s. The FDIC was a way to encourage the retail population to trust banks with an average amount of savings so that you wouldn't have bank runs and you could build out this fractional reserve system using a degree of trust in commercial banks. So now let's pretend this person now has $1 million in his or her Wells Fargo savings account. That $1 million isn't fully insured by the FDIC. In fact, the person has $750,000 of exposure now to Wells Fargo. So that's not cash anymore in one form. It's $250,000 in cash insured by the government and $750,000 in cash basically guaranteed by Wells Fargo. But if that person wanted to say, I don't trust Wells Fargo, takes the $750,000 out in physical US dollar notes, Wells Fargo would say, no, sorry, we don't have the paper. You can't do that. So the person says, what are my options? Well, you should invest it in a money market fund. Well, what does the money market fund own? The money market fund probably owns a bunch of US Treasury bills. So we're still now getting into government securities, but it's government securities that have no duration risk, which means they have no price risk. So when you talk about bonds being the base layer of the fiat system, what you're talking about is US Treasury bonds that have a duration of 10, which means for every 1% that interest rates move, the bond price will move 10%. So if rates go up 1%, your bond price just went from 100 to 90. That's not cash. That's not safe. And that's what you're trying to get at here, is that government bonds are not safe when they have duration and therefore price risk. It's not that the US Treasury is going to default, but you can experience an enormous capital loss on your investment if you're just investing in bonds. So cash can, and still likely is in a lot of scenarios, cash is still US Treasury securities, but it's 3-month US Treasury securities. We call those bills. So 3-month and in bills is the cash form that is now the risk-free instrument. And there is now a big segregation between US Treasury bonds and US Treasury bills and the risks that investors are exposed to. So one last thing before I'll pass it back to you is that this actually lengthens the runway of the US government and the dollar standard, the fiat standard, out potentially decades, because the Treasury realizes that it doesn't even have to offer a long-term steadiness of cash flow in real terms. It can just offer short-term cash flows that are linked to short-term interest rates and basically give themselves funding and give their investors no price exposure. Basically, you just capture the short-term interest rate every 3 months. So I know it's a long answer.
No, that's fine. That's what we're here for. So I'm just going to pick up on one aspect of it when you were saying the move toward the shorter duration. This dynamic that you're describing is essentially the inversion of the yield curve. You know, when people are scared, then they're scared of being in the 10-year and in the 20 and in the 30, because these things have very large price sensitivity, and they prefer to go to the short term. And so because of the increase in the demand for the short term part of the yield curve, the yields on the short term go up while the yields on the long term go down. And so it's essentially what you would consider as the harbinger of an inflation. And so I presume you agree with the idea that an inverted yield curve is an indication that inflation is on the doors, right? That
No,
recession is at the doors.
It is a sign that recession at the door is at the door. 100% yes, but the mechanics that you described, it's actually a little bit different than that. So the reason why a yield curve inverts is because investors are actually willing to take on the duration. They're willing to go long, the long end of the curve, and actually drive interest rates down below where they could get if they were just in cash. So right now we have 3-month bills at 4.4%, and 10-year notes are at 3.5%. So there's almost 100 basis points of inversion, which means that you could get 4.5% with a 3-month bill, but you see investors actually going out to 10 years to capture only 3.5%, because they think that 3.5% will actually be a generous yield looking forward 3 years from now. So it's basically a prediction that they think the 3-month yield will come down to 2%, let's say, over the next few years, making a 10-year lockup at 3.5% a good investment. So it is a sign of recession, but it's actually a sign of recession because investors are fearing deflation over any 5 to 10-year time horizon, or at least disinflation from the current levels. So it's advantageous to people that want to keep their money in short instruments, because they can get a higher yield in a 3-month than they can in a 10-year. They get the higher yield and they get no price risk. So it's beneficial to people that want to invest short. But the inversion of the yield curve is an expression that big money investors are willing to lock up money for 10 to 30 years in treasuries, because they think that the yield, even though it's lower than the spot short-term yield, it's actually generous on a forward looking basis.